In the second module of the course section devoted to the analysis of financial statements, we turn our attention to the first group of financial ratios, namely those relating to performance or profitability. Before we begin discussing the specific measures designed to gauge a company's performance, let us stress the importance of understanding the overall broad trend in reported revenue and the drivers of revenue changes. In particular, the analyst should be capable of explaining whether revenue dynamics are the result of changing volumes, selling prices, or both, and what effect they have on the company's share of the relevant market. The analyst should also look for linkages between revenue growth and past investments in non-current assets, advertising and promotion, as well as employee benefits. The first of the profitability ratios which analysts typically scrutinize is the gross profit margin, which is computed as the gross profit achieved over a period divided by the amount of sales revenue for the same period. This ratio indicates the percentage of revenue available to cover operating and other expenses and to generate profit. Because it is impacted by only the most basic and fundamental of costs, the cost of sales, its level is typically quite stable over the short to medium term. Higher gross profit margin reflects some combination of higher product pricing and lower production costs. The ability to charge a higher price is typically constrained by competition, so gross profits are affected by and usually inversely related to the level of competitive pressure faced by the business. If the company's products have a competitive advantage, for example, they have superior branding, better quality, or utilize some exclusive technology, the company will naturally be in a better position to charge more for them. On the cost side, higher gross profit margin can also indicate that a company enjoys a competitive advantage in production costs. It is important to stress that intercompany comparisons of gross profit margins rarely make sense across different industries. Consider a small, exclusive jewelry maker and a large food processing plant. The gross profit margin of the jeweler will most likely be several times higher than that of the food processor. That, however, does not necessarily imply that the jewelry business is the better one to be in. A company with relatively low sales volumes must generate more margin to cover its fixed operating expenses. What is more, the jewelry business will likely require high spending on selling and marketing activities, all of which need to be covered from gross profit. On the other hand, the food processing plant will typically grow by cutting unit costs and keeping selling prices as low as possible so as to attract buyers. Once again, what matters here is the size and scale of operations. A low-margin business will thrive providing volumes are high enough. The next profitability ratio which we ought to inspect is the operating profit margin, calculated by relating operating profit to sales revenue. Operating profit is naturally affected by the complete spectrum of operating costs, including one-off items such as the creation of restructuring provisions or losses due to impairment of non-current assets. Accordingly, when assessing trends in operating profit margin, the analyst must differentiate between the effects of one-off events and those which are likely to recur. It is also important to remember that as a company increases its sales levels, only some of the operating costs are expected to grow at the same rate as revenue, with others staying relatively fixed. Analysts typically compare changes in operating profit margin to those in gross profit margin. Accordingly, An operating profit margin increasing at a faster pace than the gross profit margin can indicate improvements in controlling operating costs, such as administrative overheads. In contrast, a declining operating profit margin could be an indicator of deteriorating control over operating costs. Before we proceed to the next group of ratios, let us note that a profit margin may be computed at practically any level of the income statement and with the inclusion or exclusion of whichever costs the analyst selects. Accordingly, we may compute an EBITDA profit margin, a before-tax profit margin, or the net profit margin. The margin ratios which we have been analysing so far capture the relationship between two numbers coming from the same source, the statement of comprehensive income. Let us now shift our attention to profitability measures which utilise data coming from the statement of financial position as well. First up is the return on capital employed, or ROCE, being the ratio of profit to capital employed. We should explain that capital employed is typically defined as equity plus interest-bearing debt, including all finance lease liabilities, irrespective of whether they are shown under current or non-current liabilities. An alternative approach is to measure capital employed as the difference between total assets and current liabilities. ROCE measures the profits which a company earns on all of the capital that it employs, both equity and debt. Accordingly, the numerator of the ratio must take into account the profits generated before deducting any of the returns paid to the providers of long-term financing considered in the denominator. The ROCE numerator is therefore typically associated with earnings before interest and taxes, that's EBIT, or trading profit. ROCE may easily be decomposed into two further ratios: net profit divided by sales revenue and sales revenue over capital employed. You should appreciate that because sales revenue features in the denominator and numerator of the two fractions respectively, it effectively cancels out, leaving the relationship between net profit and capital employed. The first of the two ratios is naturally the net profit margin. The second is known as the net asset turnover and measures management's efficiency at generating revenue from the assets at its disposal. You should appreciate that a natural trade-off exists between the two ratios. Low-margin businesses, such as the food processing plant introduced earlier in this section, will typically have high asset turnover. Conversely, higher margin companies, such as the jewelry maker, will typically feature lower asset turnover. A follow-on ratio from the return on capital employed is the popular and commonly used return on equity, or ROE, which is computed by dividing net profit by the amount of equity. ROE obviously reflects the return earned by a company on its equity capital. As noted, return is measured as net income, that is after making a deduction for interest accruing to the providers of debt financing. In the case of both return ratios, it is important to stress the significance of the accounting policy choices made by the reporting entity with regard to its non-current assets. Companies which adopt the revaluation model for measuring items of property, plant and equipment or selected intangible assets will potentially see their equity balances increase as a result of revaluation surpluses, and will thus achieve lower ROE and ROCE levels than their industry peers who follow the historical cost measurement approach.